Got it. Now, hi everybody. It's Tara's Talks Tuesday night. Tonight we're going to be going through the types of policies and just very high level overview of the types of policies that we have access to, what you're going to be selling, and really just super high level what each one of them does and what it accomplishes. Before we dig into that, since you will be watching this in replay, I wanted to remind you that in September 10th through the 13th, September 11th through the 13th, which means you need to be there on the morning of the 11th and stay through the 14th, because I learned the hard way last year that they have a big block party on the last night of conference, and we missed it because we left thinking it was over that night. So the 10th, the 11th through the 13th in Denver, Colorado, we have our national convention. If you get tickets now, and they are already available, they're $190. You got to get yourself there. You got to pay for your hotel. There will be plenty of people that you can share a room with if you want to look into that. But my suggestion is do not miss it. It is one of the most impactful 3 days of your life. You get to meet people in person. There's breakout sessions. You get to network. You get to, it's just the most soul fulfilling 3 days of insurance, which is very strange. I get it. But it is a do not miss. So mark your calendars and start planning. If you need to road trip it, road trip it. If you need to fly out, fly out. But make sure that you are there. So tonight, I really want to just focus super high level on the types of policies that we have available to us. You all know that we work with multiple carriers, and I'm even going to walk you through when you're looking at particular types of carriers and types of policies, which carriers to start with. So I have this document available if you want it. It's in a PDF form, and I'm happy to send it to you. You can print it out, keep it for a resource for yourself, take notes on it, whatever you want to do. But there are basically three things that we sell. We sell temporary insurance, which is a short-term policy. These last for a period of time and then they expire. Meaning if they put a policy in today for 20 years and they die in that 20 years, that policy pays out. If they die at 21 years, there is no policy and there's no payout. So a temporary policy, and we'll talk about why it is important later. A temporary policy is just a short-term policy. The older that you are when you apply, the shorter your term can be. So if you have people who are applying in their 20s, they can get a 30 or a 35-year term. If they're waiting until they're 60, they're only going to be able to get a 15-year term. That's just because the insurance companies are betting that they're going to outlive that policy. Okay. A permanent policy, we really have two kinds of permanent policies. You'll hear permanent policies called whole life policies. You'll hear them called final expense policies. There are IULs that are whole life policies. Well, all IULs are whole life policies. But these permanent policies offer a guaranteed death benefit regardless of when that person dies. As long as they pay the premium, they get a death benefit. Some of the policies that you can put in place will offer a cash value option. And we'll talk about what that means when we get to the permanent policy overviews. And then there's a whole big bucket of other stuff. When you start getting leads, and as you are getting leads, pay attention to the type of lead you're getting. If you have gotten a mortgage protection lead, likely that's a term life policy because we're tying it to that mortgage protection. If you get a whole life lead or just a general life lead, it's likely going to be one of these permanent policies. But we're really going to need to dig in with that customer to understand if it's going to be temporary or permanent, and if they need these other kinds of policies, which we'll get to later. There are variables that affect the cost of either one of these policies. A temporary policy, a term policy is usually about a third of the price of a whole life policy. An IUL is somewhere in the middle of the two. But a whole life policy is going to be a lot more expensive for your customer, regardless of age, than a term life policy will. So the variables that affect the cost of those policies are going to be how much coverage do they want? How long do they need that coverage? Can they just do a 20-year, or do they need it and want it for their whole life? The age of that applicant, the biological sex of the applicant. It's really important to remember that we're asking about what was your sex at birth and not today, because those do change. The health of that applicant and the lifestyle of the applicant. Are they a smoker? Are they physically fit? Do they take care of themselves? Those types of things. So that's just very high level, the types of policies. Let's dig in to term life policies. All right. One of the most important questions that I ever ask a customer is, what are you trying to accomplish with this policy? What's your goal in putting this policy in place? And you will hear, especially if you get mortgage protection leads, you'll hear, well, I just want to make sure that if my family, if I were to die, that my family has enough money to pay off the house. A mortgage protection policy is nothing more than a term life policy that we put in place on them. The benefits of a term life policy is they can get a lot of coverage for a little bit of money. And the reason is these insurance companies are really betting that they're going to outlive this policy. So for 20 years, they're going to have paid on this term life policy, and then they're still living, and now they don't have a policy, but the insurance company has made all of that money, right? When that term policy expires, it's important to know that term life policy, that customer will be given the opportunity to convert that to a whole life policy, or to even extend that term. But when I tell you it's more expensive, it's going to be 15 to 20 times more expensive. So if they're paying $100 a month now, when they have the option of converting that, it may be $1,500 a month or $1,800 a month. So it is super expensive for them to do that. So if they're looking for whole life coverage, and you find that out when they tell you that's what's important to them, then a term might not be right, because they're not going to be able to afford that $1,500 at the end of that term policy. But I'm going to skip around here a second. So the benefits are they get a lot of coverage for a little bit of money, and it protects against the lost future income or asset liquidation. So if you've got a 2-income family and that mortgage requires that you have both incomes, and one person dies and goes away, that income is no longer there, and this person who's left won't be able to pay that mortgage. So a term policy is helping them in the situation that if they had lost income from the death of one of their borrowers, that they would be able to pay off that mortgage and live in the house mortgage free. Something important to note, all insurance payouts, those death benefits, are all tax-free, and your person will get a lump sum that is their policy benefit at the time of their partner's death, right? Or their, whoever died, making them the beneficiary. So they get a lump sum. Just because it's called mortgage protection does not mean the value of the policy goes down as they pay off their mortgage. So let's say they have a $300,000 mortgage and you put a $300,000 term life policy in place. they're going to continue to pay down that $300,000 mortgage while they're paying on their insurance. And let's say 10 years later, one of them dies. That policy is still worth $300,000. So that beneficiary is going to get a full $300,000 check. They can take the proceeds from that, pay off what's left on the mortgage, and then they still have a lump sum of cash that they can use for other bills and other things. Make sense? Good. Okay. Stop me if there's anything, you guys have questions on. From an underwriting perspective on term life policies, pretty much everyone that we use at Symmetry is going to fall into immediate issue or simplified issue. We do have options for fully underwritten, but I've actually never done one, and I'll tell you why. Immediate issue means you're going to put in the application. You're going to have your customer on the phone. You put in the application. And before you get off the phone, you have a decision from that company. Immediate issue means they are covered by the end of that phone call. The magic of the internet allows that insurance company to go out, check the MIB, look for any kind of health history records, whatever that might be, verify that the information we've provided in the application is correct, and boom, you're either accepted or you're denied in that very first setting. If you can't use an immediate issue, it's okay. Or if you get declined on an immediate issue and it happens, you can go to simplified issue. Simplified issue means simply that you put the application in, and then it's going to go to underwriting. And it usually takes 2 to 4 business days to go through the underwriting process, with the exception of legal in general, and legal in general can take weeks to go through that underwriting process. So just take that and write it as a note. It's never fun to go through an underwriting process with legal in general, but sometimes they are the best option for your customer. The last option is fully underwritten. What that means is that you are going to, and you do have to do these occasionally. If you've got someone who's medically not able to qualify for immediate or simplified issue, you can run them through a fully underwritten policy. That's just called full med or medical. And that just means that the person's going to have to go to get a physical. They're going to have to go get blood work. You're going to have to chase them down and make sure they've made that appointment. And then you're going to have to chase them down and make sure they've done the follow-up. Those take 4 to 8 weeks to close and issue a policy. So last ditch effort is fully underwritten. All right. Term life.
Okay, I was going to add, here's how I think I've been told about it, is that immediate issue, it is simply algorithm and AI. There's no underwritten, no eyes of an underwriter reach that, because, and usually this is where you're really healthy people, or maybe they have one thing going on, they have high blood pressure, or they have cholesterol, or they have one thing, that it's easy, and that, they're going to, there's no reason that they're not going to be approved. And that usually, and SBLI is the one that I use the most for immediate. I would love to know your thoughts on which
We'll
carrier.
go through that in a second. Yeah, I'm going to go through
sorry. And then simplified issue is almost the same. It's 90% AI and algorithm, but there is a human that looks at it at the end of the process, like, yep, nope, got it, as far as the underwriting process, but it's usually pretty quick, right? And then the fully underwritten is just like you said, where they send out paramedics to your house to get urine, blood, saliva, and it takes a while to do that. Okay, that's how I explain it to people, because usually some people have a thought like, well, what is underwriting like? And I think everybody automatically goes, if they don't know anything about insurance, they go to fully underwritten. And whenever I explain, no, not at all. We have these other ways of doing it. It's a selling tool. It's a selling point. So
it absolutely is. So these immediate and simplified issues, that is a differentiator between the carriers that you are representing and the carrier and other carriers that are out on the market. They don't have to go do all of that. So it's a really good point. Term policies are best for people that are 18 to 65. You will occasionally, and I've put policies in place, you'll occasionally talk to someone who's 70 years old and wants a term life policy. And I'm like, let's go get you one. But they are really best for people that are 18 to 65. And when you think about financial obligations, that just means that they've got a mortgage, or maybe they've got kids in college, or maybe they've got debt, or maybe they have a business loan that they need to pay off. And if something were to happen to them, then their beneficiaries would be stuck and on the hook for paying off those financial obligations. So these term policies we really put in place to help solve the problem of those financial obligations. And you can tie it to the length of time that they think they need to have it to, to pay off and all of those things, which we won't go into tonight. But that is who they are best for. The idea behind a term life policy is that your client is going to be in a different financial situation by the time that term expires. So if they're 30 years old and they have a 30-year mortgage and we put a 30-year policy in place and they don't die at 60, it's okay because now their mortgage is paid off and they don't need that coverage anymore. And also that we talked about, there is a specific problem or debt that we're trying to cover, either current or future. You will find as you're talking to young customers I'm going to say below 40, a lot of their concern will be, if something were to happen to me, I want to make sure my children have a college fund and that my passing doesn't impact their ability to continue their education. So that is the premise behind this term life policy. So here is what Tracy was asking about, where do we start? As you are going through the client qualification form with a customer and you've gathered their date of birth and their height and weight and their medical issues and their prescriptions and their fact that they're a smoker or they're non-smoker, and you've gotten all of that information, you're going to go to start looking at, the worksheet on SFG quotes to see, what are the policies that they may cover, that they may qualify for. That's just like with Tracy, I start here. I start with immediate issue and see, can I get them through SBLI, right? Can I get them through SBLI? And if I can get them through SBLI, and I look at the underwriting guidelines for SBLI and it looks like we're going to, that's the place I start because it's immediate issue. And oh, by the way, SBLI pays the next day. Now, if you're brand new, you can't write with SBLI until you've put in 6 applications somewhere else. So you've got to get busy getting other applications to get your writing number with SBLI. So it doesn't matter, right? It's totally fine. You still have very good options to go with, but it is kind of a big deal when you can finally get your writing number with SBLI and start here. I'm going to tell you SBLI is super picky because the fact that they're using AI and they're using algorithms, if anything kicks them out, or if anything is flagged, it will kick them out. So my pro tip on this is, even if you feel like SBLI will be the right product for your customer, always have one of these in the backup so that if you get to the end of this application and you get a big fat declined, and believe me, we've all had it multiple times, you have set the expectation with your customer of, hey, we may get a decline on this, but that's going to be a good thing if we do, because now we'll know what the issues are. I have backups and we'll just go forward with another backup if we get a decline. But hopefully you can just go through immediate issue. John Hancock also has an immediate issue. I'm going to be super honest. I've never done a single policy or even run a quote with John Hancock, so I can't tell you a whole lot about him. Then you go to simplified issue. This spreadsheet was created before Navigator, by the way. Now you have Navigator that you can plug all the information on your customer in for a term policy, and Navigator spits out all of the options for you, which is beautiful. So, but you still can use this cheat sheet to say, okay, do I want to go with AMAM, go the Term Made Simple or Express Term? Do I want to go with Moo's Term Life Express? I'm loving Americo these days. They have the easiest application process and they are issuing like crazy. And I am loving Americo these days. And they're very competitive on rates. But these are all the ones that are in the simplified issue bucket. And then here's your fully underwritten group down here if you ever needed to go there. Please note with AMAM, in Navigator, AMAM has a policy that's specific to Quility. It is not all of the products that they offer. So often when you get the option from AMAM and it's the Quility product, I will go and bounce it up against and log into AMAM and run a couple of quotes on Term Made Simple or Express Term just to see the pricing comparisons. All right. Those are all just tips and tricks that you'll figure out through time. But while you're taking notes, note that one. There are some common riders that you can put on any of these policies. Child riders are real common for people to add to their policies. I'm going to note, though, with a child rider, you can only do up to $10,000 of coverage per child. And I'm going to tell you later how to be able to write a bigger policy on those children by just putting in a Children's Advantage policy, because a Children's Advantage policy, you can get up to $50,000 worth of coverage. So we'll talk about that as we get there later, but you can add child riders on almost any of these products up to $10,000 per child. All right. You can add accidental death to any of these policies as a rider. Another pro tip, you can just put a separate accidental death policy in on them through Mutual of Omaha's Guaranteed Advantage. And now you've got multiple policies with this customer, but you can add. Return of premium is getting fewer and far between with our options. There are very few companies that are offering return of premium right now. Some are. Return of premium just means if they were to outlive that 20-year term policy, that the company would give them back all of the premium that they had paid in. But it's not very common anymore because companies realized they were losing money doing it. Waiver of premium is a rider that you can do that if the person were to get sick or not able to work, they can waive the premium while they're on unemployment and not lose their coverage and just pick those payments back up when they go back to work. And then there are disability premiums that if they had, not premiums, riders, that if they did have an injury or an accident, you could add a disability rider. All of these are not available on all of these. They are common riders that are on most of them. Any questions?
Are built in also. I know like the Term Made Simple, they have, well, I don't think it's one of those, but they have critical illness, what's the other words? They have living benefits that are built in to that particular policy as an example.
Yeah, most of the policies that we work with do have living benefits. You're right. And that's a good thing to highlight. Living benefits just means if you are diagnosed with a critical or a terminal illness and you're given 2 years to live, that you can pull forward from your death benefit access to those funds. So, you've got a $200,000 policy and you are given 2 years to live and you decide we're going to go on a $50,000 around the world trip and you want to take $50,000 of that, you can. And they don't care because they know you're going to die in 2 years. That sounds very callous. I'm sorry. I should have sounded a little softer and professional in my presentation of that, but I didn't.
No, I just think that ability to do that, is super awesome. And that's also the difference between, not that I don't think SBLI, you might can add it on, but you cannot, it doesn't come with it. And usually that's why SBLI is more economical, right? It's just usually a flat benefit, versus like Term Made Simple, AMM, and the America. Not all of them. They don't have all these riders built in, but they have a lot of them, and it's usually a little bit more money, but it's worth it.
And the way that you're going to find out what riders are there is you're going to go to carrier resources in HQ, and you're going to log into each one of the carriers, and you're going to look at the policy documents, and it clearly, you'll see flyers. They all have a flyer that is like a customer facing flyer that you can present to your client so that you can show them the riders that come with the policies, etc. So now let's talk about permanent life and whole life. So as we talked about earlier, it's super important to understand what is your client's primary goal. If they are looking for a guaranteed death benefit or cash value, and you'll hear that a lot, you'll see there's a lot of advertising on TikTok and Instagram and everywhere else these days that's teaching people about the ability to earn cash value in their whole life policies and be able to access that for loans, for paying for college or whatever. So when you're talking to someone and they say, hey, I'm just looking to make sure that when I die, they can pay for my funeral and pay my final expenses, they're probably not looking for this cash value. They're probably just looking for that guaranteed death benefit. But if you're talking to someone who's super savvy and says, I'm looking for the ability to create equity in this policy so that I can draw from it and build on it and use that as a source of income, not income, as a source of loans and paying myself back, then you're going to be looking for something different. So final expense policies are best for people who are 65 and older. You'll find a lot of final expense policies won't even let you apply unless you're 50, which is really hard when you're trying to talk to someone who's 37 and trying to figure out the best option. And you're like, I really don't have anything in a final expense policy. You have to go put them in an IUL or something else. But true final expense policies really are best for people at 65 and older. The largest one that you can get is $100,000 through American Amicable, but it is possible to stack policies. So if you see someone that says, I want $150,000 final expense policy, you're like, okay, that's totally fine. What we're going to need to do is stack a couple of them on top of each other. So get one at Mutual of Omaha, get one at Americo, and get one at AmAm. And that's totally normal and it's totally doable. But just know that they typically you aren't able to get as much coverage as you can back on the term side. People under 40 are also a really good candidate for these whole life or permanent policies because it gives them time to accumulate cash value, and they have time for that value to grow, and then they have time to access it as a down payment on a house or whatever they're looking to do. We do have policies that allow 40-year-olds or 25-year-olds or 19-year-olds to get those whole life policies. So we'll talk about where those are in just a minute. These are best for high net worth individuals because if you've got someone who's sitting with, I don't know, $75,000 in a cash account at their bank, they're earning no interest, none whatsoever. But we could take that $75,000 and front load a whole life insurance policy, and it allows them to gain that cash value into that policy more quickly. And then they can borrow against that instead of borrowing against the bank. And so lots of magic behind all of that. But know that if you've got a high net worth individual, this could be a good way for them to have a tax shelter for some of that money. It's great for minors. Whole life policies are awesome to put in on kids because it guarantees them insurability when they are 25. Plus, it allows them to do that cash value. In Texas, we had that Texas Tomorrow Fund where you could where you can invest in your kids' future college expenses. And had we all known about this years ago, I think the better option would have been to put a whole life policy in on your child and build the equity that way versus putting it into a high risk market fund. But that's for a different day. But it is good for those people. And it's good for these permanent life policies are good for people who are otherwise uninsurable. You guys pay real close attention to this. I didn't get this when I started. I just didn't understand that there were going to be some people that the insurance companies just won't cover. They're sick. They've had a heart transplant. They've taken 19 medications a day. And I have talked to so many people who have. They are not height weight proportionate. Their BMI is too high. They're 5'2" and 375. And you will talk to those people. Those are people that the insurance companies are not going to take the risk to cover them. But we do have 2 different carriers that do a guaranteed issue whole life policy. Guaranteed. They don't care how sick you are. They will put a $25,000 policy in on you for final expenses. It's not cheap, but you will find that a lot of people are interested in doing that because it at least helps with that $25,000 final expense coverage. So Corebridge is who we use most of the time, which is, I just forgot the name of them, the other name of them.
Well, it was
Corebridge.
AIG, but
AIG,
yeah.
yes. So you'll see them referenced a lot as AIG. So AIG and Corebridge has a up to $25,000 guaranteed issue whole life product. I'll give you an example. I spoke with a man in Florida a few months ago. He is in the last 2 years of his life, most likely. He was diagnosed with stage 5 prostate cancer, and he is dying. We put a $25,000 guaranteed issue whole life policy in place on him because it was all we could get for him, but he wanted something. Now, here's the kicker with a guaranteed issue whole life policy. If they die in the first 2 years of that policy being in place, their beneficiary will get back all of the premium that they've paid in, and they will get 10% added to that. So 10% of whatever premium they've paid in will be given to them at the time of their death, or the beneficiaries will receive it at the time of their death. In order to get full payout, they have to live past the 2-year mark of being insured. Otherwise, it is what's called a graded benefit. And that just means it's graded in that 2 years, and they only get back a portion of what they've paid, or they get back what they've paid in plus 10%.
Go back real quick, if you wouldn't mind, to the minor and the guaranteed insurability. I think this was months ago now, but I can't get that poor boy out of my mind about I think he was 19 and had brain cancer, if I remember correct.
No, so I had a mother that I bought a lead, and the mother, as I'm starting to try to communicate with this kid, the mother picks up the phone and she was like, he's in the hospital and he's dying. And is there anything that we can get for him, just to help me cover his costs when he's dead? And the truth is we couldn't. I could put an accidental death policy in on him, or he's too young for a guaranteed issue whole life policy. So she didn't want to do an accidental death policy because he was in the hospital literally dying. So we didn't, right? We didn't do any policies. But the point of that is, the younger that you put an insurance policy in on your child, a whole life insurance policy in on your child, it locks their insurability in place so that if they get a diagnosis of whatever, brain cancer or autism or all of the other things, juvenile diabetes, all of the other things that could prohibit them from getting insurance in the future, By having that whole life insurance in place on your child when they are young, they cannot be turned down regardless of any kind of diagnosis at the time they're, trying to look for a different policy through that same carrier. Of course, they would have to go through Mutual of Omaha, which, so children's life policies, they seem really scary to talk about with families. I wasn't going to talk about it here, but it's a good time to. Children's life policies feel like they're kind of scary to talk about because parents automatically go to, man, I don't even want to think about that. I can't even imagine my child passing. I don't want money if they die, right? I don't want them to die. And so I don't even want to think about that. But if you can turn the script on them to say, of course not, of course we're not looking at that. What we're looking at is instead helping them build cash value for college, or a down payment on a car or whatever. But most importantly, we're guaranteeing their insurability in case there is some kind of diagnosis that prohibits them from getting insurance in the future. And when you can switch that terminology for them, it makes a huge difference. And parents are like, oh, well, I get that. That makes a lot of sense. And that's another reason why I don't like to do riders on the parents' policy. I like to put a kid's policy in on themselves. They're so cheap, right? I mean, you can literally get $50,000 for $8 a month on a kid. I mean, it's so cheap to put those policies in place. So, back to permanent life. So the cash value concept on a whole life policy is that any cash value policy requires overfunding. So you think like a mortgage, you are building the equity into that policy up front. So like if you have a mortgage, you put a down payment down on your house, and then you're paying your premium every month to pay down your mortgage. If you wanted to make a lump sum and pay your premium down faster, you could, and that would allow your mortgage to shrink in terms, right, of how much longer you have to pay for it. There are options for doing more than the minimum payment made, and the cash value concept really requires a lot of time. These policies, these cash value concept policies, these are really targeted for advanced market agents to be able to help you sell. And we're going to talk about advanced market agents. You can sell IULs, but you can't sell annuities. You can't sell an infinite banking. You can't sell debt-free life right now. You can get certified to do that. But these policies really are very advanced, and you would want to pull in an expert to do that. I'm getting certified in that right now. Tracy's getting certified in that. Rodney's going to get certified in it because I'm going to make him. It is definitely on your career path, guaranteed. But if they're not looking to overfund it, not building that cash value in it, your premiums are kept relatively low. It's not designed for cash value, and it does provide that guaranteed death benefit. So here's where we start with permanent life policies. Always remember, answer the question, solve the problem that your customer is looking for you to solve. Solve that problem first. I'm looking to make sure that my funeral expenses are taken care of. Great. Let's look at putting a final expense policy in place for you that covers that. Or I'm looking for cash value, blah, blah, blah. Great. Just like Rodney, when I pulled Michelle Baldwin in, when you and I talked, she's a subject matter expert that could help us with that conversation. Don't get bogged down in, here are all the other things I could sell you, and here are all the other things I could do. Solve the problem that they want you to solve first, and then start talking to them about some of the other things we're going to talk about in a minute. With the permanent life or whole life or final expense policies, my three first choices are Mutual of Omaha's Living Promise, AMAM's Dignity Solutions, and Americo's Eagle Premier. If they are, hold on, if they are, Eagle Premier is for someone from 40 to 85 years old. But America does have a final expense policy that will go a little bit lower than that. But your final expense, if you've got somebody who's looking for 50,000 or 100,000 or 30,000, go here. These guys are pretty easy to work with and you'll get your policies through pretty quickly. If they're looking for cash value products, again, Forrester's Advantage 2, Pathsetter's IUL, the Symmetry Advanced FIF, and your advanced market team are where you should go. I will say this with a caveat. Every single person listening to this message, as long as you are licensed, you can write IULs, okay? Americo has a fantastic IUL illustrator out. That means you can go in, you can log in there today, and you can run an illustration of what an IUL would look like for you that shows the cash value, it shows the death benefit. Just know that IULs are complicated, and do not try to sell one unless you truly understand the product, because those products, all IULs and all of the products in this group right here, they're tied to the market. Results of those products are tied to the S&P 500. Now they have a floor, they can never lose money, but it's just a little bit different sell. In HQ, under training, under summit, you can go in and do a certification class on how to sell IULs. I highly recommend you do it. It's not quick. It took me several days to get through it, you know, working it a few hours every day. But it's very, very informative and will help you at least understand the premise behind an IUL. Other whole life policies that we use, minors insurability. I've already talked about Moo's children whole life policy. Forrester's also has a bright future policy. This is just, these two are really just used if you're looking to make sure that you're getting the coverage. If your customer says, I want my minor to gain cash value, these are IULs. And again, you can run them, but you need to make sure you understand them, or you need to pull in myself or Michelle Baldwin or Tracy once we get our certification done, pull us in to help you with those, okay? If you're not looking to overfund, Moo has a very good, straightforward IULE. I've written several of these, actually. The IULE just stands for IUL Express. It is a cash value, but the cash that is earned, the cash value that is earned is paid toward the premium, and that's how they keep the payment so low. So if you were to compare a Moo IULE and an Americo IUL, the premium is going to be less on a Mutual of Omaha, but their ability to earn a bigger cash value is going to be lower over here. The truth is, both whole life and IUL, they're both safe. They both come with floors. You're guaranteed, literally guaranteed, that whatever you put in there, whatever you invest, you are not going to lose money. But the difference is a whole, go back. A whole life policy, you are earning dividends based on the company's performance, where an IUL is based on the S&P 500 or other indexed funds. So it's really just about the risk and the reward. I know that's very deep on permanent, but I want to keep going. The last thing we do, and these are where, to me, this is where we really start adding value to our customers. If you have the opportunity when you're talking to a customer, one of my favorite questions as you're kind of going through their health history and you're really verifying all of their health information, I love to ask them, so in your family, in your immediate family, do you have a history of people who have had cancer? Or do you have a history of people who've had heart attacks or strokes or other health issues? And by the way, the answer is always yes. I've never had anyone who didn't. There are, Moo has a critical advantage policy that you can put a cancer policy up to $100,000 or a heart attack and stroke policy up to $100,000. And you can do riders of the other one on it. So you can basically put a policy in for cancer, heart attack, and stroke up to $100,000 that if something happened, and let's say, I'll give you a great example. Mike and I both have had cancer. My husband and I are both cancer survivors. And so we have cancer policies in on each of us so that if we were to get diagnosed again with cancer up, till we die, as long as I pay the premiums, we would get 100, and we have both $100,000 policies. At the time of diagnosis, you literally get $100,000 tax-free check that you can use to pay for care, for medical costs, for, I don't know, whatever you want to cover, right? Go on a big trip. That's probably what I would do. If you know me, that's what I would do. But this critical advantage is such a good policy. Again, I don't try to sell this until I've dealt with their first problem. I take care of their final expenses or I take care of their term policy. But while I was talking to them in the beginning, I learned that they do have a history of cancer in their family. Their mom and their dad both had cancer. So after we get that policy taken care of, and I'd gotten that one issued, I circle back and I say, okay, now that we've got that taken care of, I want to talk to you about this other policy that you might want to consider. We've got this critical advantage through Moo, and maybe that would be something that would be helpful for you. And that is a lump sum payment in the diagnosis, at the diagnosis of any of those. The other policy that you're going to get real comfortable with is an accidental death. Many of you already have one on yourself because it's one of the policies that we suggest you put in when you get here because it helps you learn the process. But I always use Moo's Guaranteed Advantage because these are, it is a guaranteed issue. They don't care. You can get a $500,000 policy for a little bit of money. And these are often your last ditch effort to help get someone covered. So if they do have health issues that do not allow them to qualify for other policies, accidental death is something that you use a lot as a, hey, well, we can at least get you this. Accidental death only pays out if they die in an accident, a car accident, they fall off a ladder, they get hit by a truck. If they have a heart attack and that's what causes the accident, that doesn't pay out. But that is what your accidental death is going to be. I run an accidental death quote on every single customer before I call them. I have it as my last little, if I can't talk them into any of this is my last little ditch effort down here in the bottom right. Disability, we have a whole training on how to write a disability policy out on our Vimeo page. Again, I do not try to sell this in the beginning, but I actually have a really good record of the highest disability product written because it was a person who was self-employed and we needed to put a life insurance policy in on him. And so after I put the life insurance policy in on him, I said, okay, now what happens? You're the breadwinner. What happens if you can't work? What does that look like? And he was like, well, I don't know. We don't have enough in our savings. I couldn't live for 6 months if I couldn't work for 6 months. So we were able to put a disability. Disability comes in two forms. It's accident or accident and sickness. So again, there's a whole training on how to run disability quotes, but know that that exists. The last piece of this is FIF resets. I am going to be adding a video today as soon as it goes live. If you missed Sarah Reineke's call today, there was a couple on there. I can't remember their names right now, Jim and Aaron, I think, or Darren, I don't know, somebody. And they did the most amazing FIF reset training I've ever listened to. FIF resets are where you are taking care of the problem that you were asked to take care of, but then you are walking them through a process of maybe helping them put an IUL in place, or do they have extra money? Do they have a 401k that's sitting on the side that they're not doing anything with? And you can put them in touch with and connect them with an advanced market expert, which will be me or Tracy in our team at the end of May. We will be there. And you, just by pushing that lead over to one of us, you qualify for 40% of the commission. You do none of the work, and we walk them through whether or not any of these products would be good for them. If it's not, it's not. But if it is, and we can teach them how to have a debt-free life and go through that program with them, that is something that we definitely want to try to do. So I went through a lot of information. I know it was fast and furious, but this deck, I have it. If you want it, just send me a text, 469-264-1954. Send me a text and your email, and I will email this to you. It is a deck that I literally have printed out, and I reference it on a daily basis still on how to, you know, kind of work through what I'm trying to solve with that customer. Any questions? I am 3 minutes before the end of the hour. I'm pretty proud of myself.
Hey, Tara, real quick, the FIF experts on Sarah's call today was Derek Fitzgerald and his wife, Erin Sheridan Fitzgerald.
Perfect. Like I said, I'll be putting that on our Vimeo page so that everyone has access to it, and I'll drop it in GroupMe. It is literally a life-changing. Rodney, you will want to listen to that call, 100%.
Yeah.
Any other questions?
That was all super helpful. I didn't catch the dates though for that conference. What days are
September? It's September 11 through 13, but you'll want to be there at least the morning of the 11th through the 14th.
Okay.
And details will be coming out about hotels and all of that as we get closer to it. But it is a do not miss. And oh, by the way, you do not have to be a licensed agent to attend that meeting. So if you've got friends that you want to bring with you, that you're trying to recruit and join the business with you, I highly recommend that they come, because there's no way you can leave that conference and not want to do this business. There's no way.
Oh yeah, I'll have a group.
I love it.
Awesome.
I love it. All right, I'm going to hit stop on record if I can figure out how. Recording, stop